everyone. Welcome to the Monday Futures Market Outlook for July 8th, 2013. This is Patrick Ceresna here. First off, we take a look at this dollar index, and we've had a very impressive rally back in the dollar all the way back up to the 84.50 level, driven by distinct weakness in the British pound and the euro. We've now approaching again some key levels, including some of the highs that occurred back in the summer of last year. This is a level where the dollar index can potentially break out. We still remain relatively bullish the US dollar, as we believe there's room for the dollar to strengthen against currencies like the euro. At this stage, this extended move has plenty of room for a reaction or retracement back a little bit, so it wouldn't surprise us or rule out that at some stage here we have a little bit of a throwback, maybe back to the 83.50 area or so on the downside. But really at this stage we are open and looking for the idea that the dollar index may attempt to actually break out on the upside. If we get above these previous highs, there really is a lot of room for the dollar index to go. It will have to be driven by a lot of counter currency trends, particularly even further weakness in the yen or a new breakdown in the euro. We'll be watching what currency can drive that, but there is still room for bullishness, but there is overhead resistance here. So next year I want to take a look at the euro, and much of that drive in the US dollar strength has really been by this euro drop right over here. We're again coming to a pretty key level. There was key lows put in by the euro at all along this 128 to 127 zone, and really at this stage this is going to be a make it or break it level. Really we are due for a little bit of a reaction or retracement back to even 130 on the upside for a little bit of a short-term push. But at any stage, if the euro does break down to a lower low, it may really open that window for a drop down to this 126, 125 target. This would be our initial downside target on a breakdown, but really the floodgate could open on the euro, particularly if driven by new policy changes in the eurozone that could really open that for even a drop down to last year's lows, which could be even as low as 120. And so we're negative the euro, but really we need to see a break of these support lines in order to see that begin to accelerate. Next year I want to take a look at copper, and copper remains distinctly weak, just like we see in many other precious metals. We have broken to lower lows, and we're now hovering with numerous tests of the $3 area on the price of copper. Really at this stage, this chart distinctly remains bearish. While there's always the chance that there could be a support that comes in along here, until a bottom has been proven, we do have to look for the risk that copper will continue its predominant trend, and a number of measured moves continue to suggest weakness down towards even as low as 275 on the downside. And so we remain negative copper with room for even another 30 cents lower if it breaks down to lower lows. So we'll watch to see whether or not there's any follow through there. Next year I want to take a look at crude oil, and crude has really gained some momentum. It's probably the only commodity right now that is distinctly bullish, being driven by some a Middle Eastern conflict, which is adding a premium to it. We certainly had a very bullish breakout, and including a break to a higher high, as we've seen even intraday prints in 103, 104 on the upside. Really at this stage, we're trying to determine whether or not this is the beginning of a new bull move, or whether or not it could fake out based upon a resolution to the Middle Eastern concerns and geopolitical concerns going on there. One way or another, we're respecting the trend that's in there. There's a number of measured moves that have finished, so there's oil prices are entitled to have a little retracement of a couple dollars, but so long as we hold above the $100 area, we have to remain open to the idea that oil can still substantially strengthen. If we go back a little bit further, you can very easily see that a breakout on the upside could easily come and retest this 106 to 112 area consolidation levels that occurred back in the early part of last year. And so that's not levels that oil cannot see. So at this stage, there's room for oil to potentially be bullish so long as it can hold above there. Below 100, we would go back to a very neutral stance. Above 100, we're open to the idea that oil can actually continue to strengthen. Next here, I want to take a look at gold prices, and gold has now retested the 1200 level a second time in today's session. While we're not necessarily convinced 100% that this is a double bottom or that there's nothing but upside from gold, we do want to point out that from measuring symmetrical moves off of these consolidation levels right here and here, the symmetrical moves suggest that this move on the downside is over. Now that doesn't necessarily mean a new bull market is beginning in gold, but this could be a level where we get a very reasonable bounce in gold that could see it retrace back toward the 1300 or even 1350 areas on the upside. Subsequently, if gold, we start seeing over the summer that gold is no longer aggressively selling and doesn't break lower lows, we at that point would start looking at the idea that we may have seen the lows of gold. But I think that gold is not going to take off to the upside in a very rapid fashion, so we don't need to be rushing to load the boat trying to call a perfect bottom. Let's just let the price of gold start to develop in the upcoming month and see whether it starts to behave a little more bullishly as opposed to this very distinct bearish trend that's been so dominant over the last year. Next here, I want to take a look at the 10-year Treasury bonds, which are continuing to be very distinctly bearish. We've had probably one of the largest moves in the bond market in many years in this drop. And with this being a pivot flag right in here, there's still actually room for the bonds to continue to decline toward last year's lows, somewhere around the 123 area down below. At some stage, there will be a retracement back in bonds and potentially even a return back to trend, depending on how the market interprets the Fed's actions. But clearly what we're seeing in the 10-year bond here is that the marketplace is sending the Federal Reserve a very distinct message, and they're forward running the belief that there is room for the Fed to stop all of the quantitative easing that they're doing. We, in the bigger picture, don't believe that the Fed will leave that marketplace, but that's a bigger picture trend that we believe will eventually develop. But at this moment, bonds remain vulnerable for further weakness, and that we haven't even seen the beginning of a short-term bottoming formation or anything that would indicate a reversal of trend. And so the dominant trend of a weaker bond market and subsequently rising yields is still going to dominate here until we see something that changes that trend. Finally, I want to take a look at the S&P 500, and we had a pretty important test down here at the 1550. That was a completion of corrective zigzag, which in fact at this moment cannot be ruled out as simply just a correction within the primary bull market. Not much different than a correction that we've seen here. The question, of course, is will the market be able to engage into a new bull run, or will this fake out as a double top and subsequently initiate a much bigger and deeper market correction? And this is something that we're going to be observing up here as the market rallies up. As we approach towards 1650 up here, the market has a legitimate chance of failing at these levels, and so we're going to be watching not only how the market behaves into overhead resistance, but more importantly how it also behaves during little throwbacks. At some stage, the S&P could easily throw back towards 1600, 1610, 1620. But so long as the buyers accumulate on those, then there's also room for follow through to the upside. The only we've been pretty bearish, looking for at some point a much deeper correction. But the way we want to really at this point make it clear is that, and we need the market below 1600 and 1610 zones, right along these zones, in order for us to feel confident in supporting a bear case. At this stage, so long as the market remains above those levels, then the bulls will remain in least in somewhat control, in the sense that not necessarily that they're going to take it that much higher, but really there's no, it's not going to bring about any aggressive selling. And so really at this stage we're very neutral on this market. There is always a chance that we could see a bull run up towards 1700, maybe even 1720 or something like that on the upside. But we do believe in the much bigger picture it will be a very choppy and difficult summer. And so even if there is a short-term bull run up here, you can try to clip yourself a profit in and out move, swing trading this market higher if we get a little bit of momentum. But we wouldn't be too eager to be looking at things as an investment, but rather as a trade. And we'll watch to see how that continues to develop. That was your Monday Futures Market Outlook. Thank you for joining me.